The 2017 Tax Cuts and Jobs Act, TCJA, significantly reshaped the U.S. tax landscape, especially for high net worth individuals, HNWIs. One of its most impactful changes was a temporary doubling of the estate and gift tax exemption. However, this provision is set to expire at the end of 2025. Unless new legislation is passed, the exemption will revert to pre-TCJA levels, slashing the current benefit by nearly 50%. This looming sunset presents a once-in-a-lifetime opportunity to implement estate planning strategies that could save millions in future taxes. If you have substantial assets or cross-border holdings, the time to act is now. What's changing in 2026? Here are the primary tax provisions scheduled to expire or change at the end of 2025. Estate and gift tax exemption will drop from $13.61 million 2024 to roughly $6.8 million, adjusted for inflation, exposing many families to federal estate taxes. Top individual tax rate could rise from 37% to 39.6%. Capital gains tax rates could be subject to further changes under new political leadership. Income tax brackets and deductions, return of higher rates, and reduced standard deductions. Pass-through deduction 199A may be repealed, affecting business owners using LLCs and S corporations. The window to leverage today's favorable tax rules is rapidly closing. Strategic planning opportunities for HNWIs. Here's how savvy individuals can reduce exposure and protect generational wealth. 1. Maximize gifting before 2026. The current exemption allows an individual to gift up to $13.61 million without incurring gift tax. Married couples can transfer up to $27.22 million. These amounts are expected to shrink dramatically. Action. Gift appreciating assets, business shares, or real estate into trusts now, locking in today's exemption. 2. Use advanced trust strategies. Irrevocable trusts protect wealth and remove it from the taxable estate while still offering flexibility through sophisticated planning. SLATs, spousal lifetime access trusts. One spouse creates a trust benefiting the other, allowing indirect access to the assets while removing them from the estate. GRATs, grantor retained annuity trusts, useful for transferring appreciating assets to heirs with minimal tax exposure. IDGTs, intentionally defective grantor trusts, allow income to be taxed to the grantor while the trust assets grow outside of the estate. 3. Family limited partnerships, FLPs. These entities allow families to consolidate assets, retain control, and gift shares at discounted values due to lack of marketability and control. Benefits: lower gift and estate tax burden while centralizing wealth management. 4. Charitable planning. Establishing donor-advised funds, DAFs, or charitable remainder trusts, CRTs, enables you to receive immediate tax deductions. Support long-term philanthropic goals. Reduce estate and income tax exposure. 5. Asset repositioning. Re-evaluate your investment and real estate portfolios. Harvest capital gains under favorable rates, and consider the impact of higher future taxes on investment income. International considerations for global families, FAS CPA, and Consultants specializes in supporting international clients. Here's what you must know. 1. Foreign asset disclosure. Failure to report foreign accounts, companies, or trusts can result in severe penalties. FBAR must be filed if you have foreign accounts totaling over $10,000. FATCA Form 8938, required for individuals with significant foreign assets. Forms 3520 and 5471, critical for reporting ownership or beneficiary status in foreign entities or trusts. 2. Cross-border estate planning. International families face overlapping tax regimes, residency rules, and compliance demands. Solution: use foreign and domestic trust combinations, tax treaties, and dual residency planning to create efficient structures. 3rd, Treaty optimization. Some treaties allow for estate tax relief or lower withholding tax rates, especially relevant for clients in Latin America, Europe, and Asia. Real-world scenarios and results. Case 1. High exemption gifting. A couple with $20 million in assets used irrevocable gifting to shelter $27.22 million in 2024 estate tax exposure dropped by over $8 million. Case 2. Foreign trust reengineering. An international family holding $10 million in assets via a non-compliant foreign trust faced potential IRS scrutiny. We restructured it using US compliant strategies, eliminating penalty risk and securing future distributions. Case 3. Business succession via FLP. A client used a family limited partnership to transfer ownership of a $12 million business to their children. This reduced their estate value and retained voting control until retirement. Why professional guidance is essential. These strategies require deep coordination between CPAs, tax attorneys, financial planners, and estate advisors. At FAS CPA Consultants, we design tax-optimized strategies for US and global families, handle complex compliance filings for foreign entities and trusts, offer ongoing consultation for wealth preservation. Why 2025 is the year to act. High net worth families have a fleeting chance to lock in historic tax advantages. Waiting until 2026 could result in substantial financial loss due to higher estate and income taxes. Proactive planning now ensures your wealth is structured, protected, and optimized for the next generation.